Hi everyone! Welcome back to another episode on our series of Accounting Made Easy. In today's episode, we will be covering the basic concepts of a balance sheet. Meet Zach. Zach has been working for 5 years and has $10,000 in his savings. One day, Zach decides that he no longer wants to work because he wants to be his own boss. Being his own boss, Zach needs to know some basic accounting concepts. Assets are anything the company owns that has monetary value. Current assets are assets that are expected to be converted into cash within a year. Some examples of current assets would be cash on hand, inventory, and accounts receivable, also known as debtors. Non-current assets are those that are considered long-term, where their full value won't be recognized until at least a year later. Some examples of non-current asset would be land, building, or equipment. Liabilities are anything the company owes to another. Similarly, it can be divided into current and non-current liabilities. Accounts payable, otherwise known as creditors, are typically due and payable within a year. Long-term loans and debts will fall under non-current liabilities as they are due after a year or more. Owner's equity is the portion that is owned by the owner. The portion owned by the owner would be what the company owns minus what the company owes to other people. In simple words, assets minus liabilities would give you owner's equity. And this formula forms the basis of the balance sheet statement. Assets of $3,000 minus liabilities of $2,000 would give you owner's equity of $1,000. And the total of both sides should always balance out. And this is why it is named the balance sheet. Some examples of what would fall under owner's equity would be capital, which is the amount invested by owner into the business. On the other hand, drawings is the amount taken out of the business by the owner for his personal use. Back to our story. Zach decides to take his savings and invest it in a fast food business. So, we record capital under owner's equity and cash under assets. In accounting, every financial transaction must have an effect in at least 2 different accounts in order for the balance sheet to balance. Zach then purchases a cash register for $200 and paid in cash. He then purchased some equipment for his restaurant. As Zach purchased a large amount of equipment, he did not pay in cash but chose to pay the bill 1 month later. Last of all, Zach rented a store for his business. Now, let's total up the sum of each category. Going back to our formula, assets minus liabilities equals owner's equity. This is how it would look if we prepare a balance sheet statement. And that's the balance sheet in 4 minutes. Let me know in the comments below if there are other accounting concepts you would like to see in future videos. Bye!